The next financial report we want to have a look at is the balance sheet. And the balance sheet is also known as your statement of financial position, which is a better name for it because it actually explains what it is. So your income statement shows you how much you made in a specific period or lost, but hopefully made. Your balance sheet shows you where your company is standing at a particular moment in time. So your income statement for March will show you how much money you made during the month of March. But a balance sheet on the 31st of March will tell you how your company is financially on the 31st of March. It will show you your assets, which are everything that you own that has value for your business. It shows you your liabilities, which is everything that you have, which is a debt to your business, something that you owe, the business owes to somebody else. And the third section of the balance sheet is equity. That is the value of the business to you. That is what you have developed and grown over the years, and is the value sitting in that business as the owner's equity. So those are the three sections of a balance sheet. But you'll see in a balance sheet that the liability and equity section is grouped together because due to the accounting rules, your total assets and liabilities need to equal your total assets. That way it balances and you get a balance sheet, which is why it is named what it is. The reason your liabilities and equity have to equal your assets can be touched on in our financial literacy course. But what you need to know to understand the balance sheet is that they must be equal. So your total assets must equal your total liabilities plus equity. Okay. When looking at a balance sheet and trying to determine if it is accurate or what it means, there are a couple of things that you want to be looking out for. You want to see that your assets owned by the business, whether they are physical things or cash on hand or loans owed to you, you want to see that those are reflected accurately. So especially when it comes to something like your cash in the bank or money owed to you by your customers or by another business maybe, or an investor, you want to see the correct amount showing on that balance sheet so that you know, okay, this is money that is coming to me or that I own. If it's a physical asset, that is the value I will get if I sell. That is the book value of this asset. Okay, so it gives you a good idea of the store of wealth sitting in your business at the top. Then your liabilities also need to be accurate because it's really important that you know how much money you owe to other people. So those, how much you owe to your suppliers, how much you owe to your tax authority, how much you owe to staff, how much the business owes to you as the director, because very often if you are director and shareholder all in one, which happens a lot in a small business, you've put your own money into this company and it owes you money. So you want those things to be reflected correctly, first of all, so that you can keep track of what you need to pay. Secondly, so that you can see how to pay, because if your assets are greater than your liabilities, you're in a good position. It means that you can meet your debts. If your liabilities exceed your assets, then you're starting to look a bit shaky and you need to make a move to change things really fast. And then owner's equity is obviously the value that you have stored up for yourself. If you were ever to sell this business or close this business, that is what it is worth to you personally. In theory, none of that is easy in practice, but theoretically, that is the value you have created within your business. So again, when you sit with your accountant and you have any questions, the first thing you need to check is that those balances are accurate. Have they been checked against supporting paperwork? Does the bank values actually meet what's on the statement? If you have a car payment due? Is your car liability matching what's on the statement? Your mortgage matching what's on the statement? Are all of those amounts correct? Is the reflection of customers due to you and suppliers that you have to pay, are those correct? And do you know how long it will take for you to set those off against each other? If something happened tomorrow, could you liquidate all your assets and meet all your liabilities and be happy? Those are important things to consider when looking at the balance sheet. And in the next video, we'll look at the cash flow statement.